Picture this. You open your investment app on a random Tuesday, not payday, not anything special, just a regular Tuesday. And you notice your account jumped up by $4,000 since last week. You didn't add a dime of your own money. You didn't work overtime. You didn't sell anything. It just happened. And here's the strange part. That $4,000 is more than you actually saved from your paycheck that same week. More than you earned, in a way, just sitting there. The first time that happened to me, I remember just kind of staring at my phone for a second, honestly a little confused, like the numbers had to be wrong. Because up until that point, money had only ever moved in one direction that felt real to me. The direction I pushed it, paycheck by paycheck, deposit by deposit. And suddenly there was this other force in the room, quietly doing its own thing, sometimes helping me, sometimes not. That, it turns out, is basically what happens somewhere around the $250,000 mark. Not exactly at that number, not like a light switch flips, but somewhere in that neighborhood, something shifts. Mathematically, yes, but also, weirdly, emotionally. And once you understand what's actually going on, you start seeing your entire financial life differently. So let's talk about why this number, more than people expect, changes the whole game. The moment your money starts outworking you. Here's the plain math behind that Tuesday afternoon surprise. If you've got $250,000 invested, and the market has a decent year, say an 8% return, which is roughly in line with long-term averages, that's $20,000 of growth. $20,000 in a single year without you lifting a finger. For a huge number of people, that's close to, or even more than, what they take home from an entire year of actual work. That's the part that messes with your head a little, honestly. You spend years thinking of your job as the engine and your savings as the fuel tank. And then one day, the fuel tank starts producing more horsepower than the engine does. It's not that your job stops mattering. It absolutely still does, especially because you need that income to keep feeding the machine. But the balance of power quietly shifts. Your money stops being just a pile you protect and starts being a second income stream, one that doesn't need coffee breaks or ask for a raise. The takeaway here isn't quit your job, obviously. It's that once you're near this number, every extra dollar you invest is working inside a much bigger, faster-moving system than it used to, which means consistency matters more than ever, not less. Because now you're not just building the pile, you're feeding a machine that's finally big enough to really move. Why 250K hits different than 100K? A lot of people talk about the first 100,000 as the hardest. And honestly, they're right. It usually is, because you're building from nothing, and progress feels painfully slow. But 250,000 is where the curve actually starts to visibly bend. You can watch it happen in real time now. Where the jump from 0 to 100K might have taken you 5 or 6 grinding years. The growth alone at this stage can add tens of thousands without you contributing anything extra at all. I think of it kind of like pushing a boulder up a hill. For a long time, at 100,000, you're still mostly pushing. Your own contributions are doing most of the heavy lifting, and the boulder barely seems to move on its own. But somewhere past 200K, the hill starts sloping the other way. The boulder still needs you, don't get me wrong, but it's also starting to roll a little on its own momentum, and that changes how it feels to keep going. It's not less important to keep pushing. It's just, finally, not the only thing happening. Why does this matter to you specifically? Because if you're anywhere near this stage, this is exactly the point where people either lock in and let the momentum compound for real, or they get distracted, ease off, and never quite feel the shift. The advice is almost boringly simple. Don't stop contributing just because the growth feels like it's doing the work now. The contributions are what make the growth bigger next year too. The gut punch nobody warns you about. Okay, but here's the part that isn't all sunshine. Once you're sitting on $250,000, market swings stop being abstract news anchor talk and start being your actual life. A rough month in, the market doesn't just knock a couple $100 off your account anymore. It can knock off $10,000, $15,000, $20,000 seemingly overnight. And nobody really prepares you for how that feels the first time. I remember checking my account during a rough stretch and just sort of wincing, the same way you wince when you drop your phone and don't know yet if the screen's cracked, except this was happening to money I'd spent years building. It's an emotional gut punch, even when you logically know it's temporary, even when you know the market always has these dips. This matters because a lot of otherwise smart, disciplined people panic right around this stage and make decisions they wouldn't make earlier or later, selling out of fear, pausing contributions right when things are on sale, basically flinching at the exact wrong moment. The takeaway is to expect the swings before they happen, not after. If you know a $15,000 dip is normal and not catastrophic, you're far less likely to do something you'll regret. When you see it happen on your screen, you start feeling rich before you actually are. Here's a funny, slightly dangerous thing that tends to happen around this number. You start to feel wealthy, not fully, never worry about money again. Wealthy, but noticeably more comfortable than you were. And that feeling, while nice, can quietly trick you into loosening up in ways that don't actually serve you yet. I've seen it happen to people, and honestly, I've caught myself doing a milder version of it too. The slightly nicer car, the more casual attitude about a subscription here or a splurge there, because hey, the portfolio's doing fine. The problem is, $250,000 is a powerful tool, but it isn't the finish line. It's the middle of the story, not the ending. Confusing the two is how people stall out right when they're building the most momentum they've ever had. So the actionable piece here is almost stubbornly simple. Keep your lifestyle roughly where it was for a little longer, even as the number starts to feel good, because this stage rewards patience more than any other stage before it. The compounding doesn't care how good you feel. It just keeps doing math in the background. And the bigger you let the base grow, the more dramatic. That math becomes later. Your identity starts to shift, whether you notice it or not. There's also a quieter, more personal change that happens here. Somewhere around this number, a lot of people stop thinking of themselves as someone trying to save money and start thinking of themselves as an investor, someone with a real stake in how markets, interest rates, even the news actually plays out. It's a subtle identity shift, but it's real. And look, that shift can be a genuinely good thing. It tends to make people more engaged, more informed, more intentional. But it can also tip into obsession. If you're not careful, checking your portfolio 5 times a day doesn't make it grow faster. It just makes you more anxious about numbers that we're always going to bounce around, regardless of how closely you watch them. I say this as someone who has absolutely been guilty of the 5 times a day thing, so do as I say, not as I once did. The practical takeaway is to give yourself permission to check in less, not more. As the number grows, set a schedule, weekly, monthly, whatever works, and trust the plan you already built, instead of narrating every tiny movement in real time, bringing it all together. So why does $250,000 change more than you'd think? Because it's the point where your money genuinely starts pulling its own weight, where growth alone can rival a year of work, where the emotional swings become real instead of theoretical, and where your whole identity around money quietly starts to shift from saver to investor. It's not the finish line, and it doesn't erase the need for discipline. If anything, it demands more of it, at exactly the moment it starts feeling like you've earned the right to relax. But here's the encouraging part, and I want you to really hear this. Everything that makes this stage a little uncomfortable is also exactly what makes it powerful. The swings you feel, the temptation to loosen up, the pull to check your account too often. Those aren't signs you're doing something wrong. They're signs the machine is finally big enough to matter. Stay steady here. Keep feeding it. Keep your expectations realistic. And this is the stretch where the years of pushing that boulder finally start to pay you back. Not all at once, just quietly, consistently, in the background of an ordinary Tuesday.